Everyone, welcome back to Yuri's Box. In this video, I'll be talking about the latest economic data and how that ties back to TLT. We'll be also looking at the '06 and '08 analogy. If you like this kind of content, consider leaving a like and subscribing to the channel. And as usual, nothing in this video is financial advice. So, as usual, I'm going to give a preamble. Talk about some of the economic data. My personal bias and later on, we'll be talking about TLT. So again, if you're not interested in the first part, by all means, skip ahead. You do your thing, and I'll do my thing. All right. So the best place to start really is with this week's economic data. All right. And we start off with inflation. All right. CPI, but downside surprise, benign read. Compared to the forecasts, we were expecting a 0.3% increase on CPI. On the month-over-month, 0.2 on core. 0.3 on core actually, and 0.2 on the headline. And we had a downside surprise, right? Year over year as well, downside surprise. Same thing for yesterday's PPI report. We were expecting a 0.2 increase on PPI month over month. We come at a 0.1% increase. Same thing for the core. We were expecting a 0.3% increase, downside surprise there as well. Now, to me, this isn't a surprise, and it shouldn't be a surprise, especially if you've been listening to my videos. I've been fairly consistent on this, on my view of inflation, which has been that it's not that inflation is dead and buried. It doesn't have a role to play in all of this. Quite the contrary. To me, any bout on inflation from here on out is more likely to cause further disinflation down the road, given the state of the labor market. All right. We've spoken about this many, many times. If you use the quits rate as a proxy, a survey of what labor market participants, what people really think about the labor market, not via opinions like, the University of Michigan surveys or conference board surveys, because again, they can easily be skewed by political leanings. And of course, we have one of the most, politically polarizing presidents, Trump. So again, it's fairly easy to fall into that trap. Again, the quits rate is the best kind of survey because you're measuring people's actions, not people's opinions. All right. And whenever the quits rate is at cycle highs, we've gone through this many, many times. That is generally an indication that people see abundance in the economy. They see, a lot of opportunities, and the fact that they see and have a lot of opportunities mainly just gives them the leverage in the labor market because they can go to their employer and bargain for a higher wage. All right. Or they can even just stay put. They don't even have to quit jobs. And again, they can bargain for a higher wage or quit altogether and change job. Overall, when the quits rate is at cycle highs, what you can expect is mainly labor demand to outpace labor supply, giving labor market participants the leverage. And therefore, you can also expect wages to be on the uptrend. And you can see this, there are many, many charts that you can look at for this. This is basically a mirror image of the quits rate. You look at February and March of 2022, that's when, wage increases. Now we're looking at average hourly earnings actually reached their peak, right? February of 2022, we're right here, okay, when the quits rate was at its highest spot. Now, again, this is true for when the quits rate is at cycle highs. When the quits rate is at cycle lows, you can say the opposite. You can expect that to be an employer's labor market as opposed to an employee's labor market right here, because the leverage no longer is in the hands of the employees. Employees are staying put for the simple reason that they no longer see all of the abundance they saw back here. So they're telling you, in essence, by not quitting their job, that the labor market isn't as strong as it used to be, and they're no longer comfortable with taking risks. And the direct consequence of that is, of course, that wages are likely to stay, at the very least, they're not going to be explosive as they were back in 2022, and that is actually what we're starting to see. Okay, 4% is still, in historic terms, we're back at 2008 levels. We're still somewhat above, pre-pandemic levels, although not too dramatically. But regardless, the trend is clear. The labor market is no longer the source of inflation that it was in 2022. And if you're an employee, or an individual, and you don't have really a means to increase your wage in a significant manner, any bout of inflation is just going to eat into your purchasing power. Meaning, I've used this analogy many, many times. Let's say you have to buy a car, all right? And you have $10,000 left at the end of the month. Before tariffs or before, whatever, you have to put down $5,000 for a down payment. Then tariffs come up. All of a sudden, you have to put up $7,500. And again, you still have $10,000 left, right? There's not much of a change in what you have left to spend. You go from having to spend $5,000 on everything else, be it cinemas, services, whatever, to $2,500. So again, that bout of inflation, that price increase causes you to spend more money on the same amount of goods, leaving you with less money to spend on everything else. And that ties back to inflation, to my view on inflation, which is that while you may see some parts, increase, and of course we will see, in my opinion, some components increase in the coming months. Again, when we work through all of the inventory we built up leading up to the tariffs, we'll have to rebuild the inventories with tariff goods, right? The increases in the prices. And that will cause eventually some kind of a price adjustment, or one-time price adjustment. So you will see potentially some articles go up, some goods go up. But if I'm correct, and we've started to see this, especially in previous reports with, airline fares, part of the services be quite benign, come down in the inflationary reports. Again, you can expect, you can have goods going up. Services perhaps will be less of a problem because, again, people will have less money to spend on services potentially. All right. And you can start to see this around, even in this report right here, with the services, flat, and they were negative the previous month. I'll leave this here so, you can look at all the services and, transportation and all that. So again, this isn't really news if you've been following my videos and really the news flow overall. Again, just to summarize, can we see some pressure on prices for goods, let's say? Absolutely. But if prices go up in one place, given the state of the labor market, you can generally expect prices to go down somewhere else because people won't have the ability to spend the equal amount of money on basically two areas. Okay. So that is basically what I've been expecting. And again, this is probably one of the first reads on inflation where it was actually, good for TLT. Okay, this is one of the first reads in quite a few months actually that actually coincided with, positive price action in TLT. All the last, I think the last 4 months have been great reads on inflation. But TLT, has been, and the bond market in general has been hell-bent on really pricing in a stagflationary outcome, which again, I've gone over that many, many times. Not my base case, but, the bond market has been saying lots of things throughout this cycle and, very few times has it been correct. Okay, do keep that in mind. What we also got yesterday was initial jobless claims and continuing claims. Okay, now this is another interesting data point right here. Initial jobless claims still sticking around 248. The estimate was for 240. This is significant because, again, my general read is that anything below 215, you can expect the following unemployment rate to decline. Anything above 220, you can expect the unemployment rate to tick higher. And we've been really sticking above that 220 line ever since, the last read we had below 220 was on April 7th, okay? Ever since, we've been really hovering around, really above 220, and the last few reads are at 248. To me, this just says that we're going to see an increase in the unemployment rate next time around, all right? Well, let's see how the next initial jobless claims read come out. Again, do we have a forecast? I would actually be curious to see. It's still kind of early, but regardless, let's see if we have a survey right now, a forecast. Not really. Again, it's only Friday, but regardless, anything above 220, you can generally expect the unemployment rate to go up. And what we've been seeing is actually precisely that. And again, just to reiterate, my base case, ever since I started making videos, is that we would see somewhat of a repeat of what we saw last year, meaning a bottom around January and a slow grind higher until, we get into the summer. Potentially, we've been seeing exactly that. A bottom around January. This is December 30th, but regardless. And we've been on the uptrend in initial jobless claims, okay? Could we see next week, initial jobless claims go back down to 230, 235? Again, it wouldn't surprise me at all, given the fact that, initial jobless claims like to spike up and then, come back down. 2024 is full of such examples. But regardless, we're still at fairly elevated levels when compared to, the lows of 2024 and 2022, when we were on the 180 and 189. So we are, in a place that actually warrants, a higher unemployment rate potentially. And again, just to give the whole picture here, I don't like to, sound like a doomsday bear or anything, because again, it's always important to keep things in the right perspective. Initial jobless claims, although they are, elevated compared to the lows, historically, we are still at fairly depressed levels, all right? Just looking at 06 and 08, the lows were 280. If we ever get to 280 now, people will be pissing their pants, right? Basically. So, and again, if you're waiting for initial jobless claims to break out in a significant manner, to say that, the economy is slowing down and the recession risks are rising, to me, I've always used the analogy of, waiting until you smell like rotten eggs to have a shower, before you have a shower. That's kind of the way it is. And again, if you're waiting for initial jobless claims to peak, to say that something's not right, you're basically pinpointing the end of the recession, not the beginning. So, and again, why? Because really, recessions are made of really two parts. The first part is a low hire and low fire environment. The lack of hiring is what pushes the economy in kind of that, into being prone to shocks. And if we do get something that, aggravates the economy, you eventually move into layoffs. But the layoff part is the final part, all right? So do keep that in mind. So again, initial jobless claims, somewhat elevated, still on the uptrend. Let's see how they come in next week. But again, given all the reads that we've had right now, I wouldn't be surprised, even, I know it's still really early, but to me, this just tells me that unless we have anything, collapsing at 200,000 or something like that, I'm expecting a rise in the unemployment rate, in the following report. Continuing claims is another interesting sight to see, in my opinion. We've been talking about this, pattern right here, potentially hinting at, I've been potentially hinting at the fact that this might be some kind of a consolidation before we, I wasn't doing technical analysis. I want to be I want to be very clear. I would never do that. But it was just looking at it was just begging for a breakout. All right. And my target originally for the summer was anywhere between 2 and 2.1 million. Let's see how things move. Generally speaking, even last year we saw a rise. We went from 1.7 million to 1.8 million. All right, now we have gone from 1.87 million. We're at 1.96 million. All right, I could imagine a scenario where 2 to 2.1 million is actually a conservative target, but I'll wait just a little bit more in order to say whether that is right or wrong. But again, I think that 2 to 2.1 million is fairly reasonable, given everything we've been going over, state of the labor market and whatnot. And again, what does continuing claims tell us? Well, it's hard to find a job. It's probably one of the reasons why the quits rate is low, because people, and again, as I alluded to before, they no longer see the abundance that they saw right here, and they know that if they quit their job, this is probably what lies ahead. The ability not to they will be unable to find a job, they will stay unemployed, and so they're gonna keep their job. They're gonna stay put. They're not gonna quit their job voluntarily. They're gonna do everything they can to keep their jobs. All right, and that just keeps average hourly earnings kind of depressed. At the very least, you're not going to see these explosive moves that we saw in 2022. And again, this is what causes inflation. This is a labor market that will cause inflation. To me, this isn't a labor market that will cause inflation. This is a labor market that's hanging in there, okay, but in a decelerating trend, which is something that you don't want to see if you're particularly bullish on the economy. All right, so these are really the most important things that came out this week for in terms of economic data. And again, initial jobless claims and continuing claims. We've been talking about this many times. Although initial claims, you don't want to put too much weight to say they're low and so nothing to worry about, because again, they do tend to break out when near the end of the recession. But again, it's still interesting to see them, slowly move up. And again, as we move towards the summer, because again, and now is probably one of the good times to switch to TLT. My base case is that yes, as we got through and actually got closer to the summer, the data would weaken and we could see some strength in TLT. But for me, the real moment, the real test was always going to be, and is always, even now, the summertime. All right, I think that the summertime, between, let's say August, I think August is would be a very interesting time, particularly if we continue to see degradation in the labor market, and if we continue to see all these trends take place, meaning that even if inflation goes up, let's say that. I remember one of the last things I said in my previous videos was that actually oil was putting in a bear flag. And of course, this was not a bear flag. And of course, this came as a consequence of, really latest actions by Israel against Iran. Again, if we were to see oil go up to $100, I mean, that to me, and I'm not saying that because, again, there are a lot of things that can happen, but hypothetically, $100 oil at this point would be very detrimental to the economy, in my opinion, given the fact that we don't have this. The labor market is extremely loose, or at least looser, very looser than it was in 2022, and it's no longer a source of inflation. Likely, it's a source of disinflation, and likely. Again, if you have oil going up, which feeds into everything, again, you're spending the more amount of money on the same amount of goods. So somewhere you're going to have to cut your spending if you're an individual. If you're a corporate, a business, again, if you know that your customers are tapped out because they're going to have to cut somewhere, that means you no longer have pricing power. It means you can't pass on most of those price increases to your customers. Meaning that if your revenue stays flat, the only and you have increasing prices, input prices, the only way you have to really protect your margins are layoffs. And again, to what you might say to that is that these big corporations like the S&P 500 ones, Microsoft, Nvidia have huge margins. That is true, but also consider that perhaps if you look at the small caps, the small and medium businesses, they don't really have the huge margins that big corporations have. So they are more sensitive to input prices going up. And again, if they don't have the ability to pass those prices on to their customers, they really are left with no other choice than move to layoffs. All right. So keep that in mind as well. So again, moving back to TLT. Personally, I am still braced for a sweep of the previous low. And as I've said many, many times before, does this have to happen? No, it doesn't have to happen. But if it does, to me, given everything we've gone over in my previous videos, that would be a buying opportunity. All right. Given the fact that the bond market has been wrong every step of the way in pricing in a recession in 2023, higher for longer in 2023, at the end of 2023, rate cuts in the early part of 2024, higher for longer, then rate cuts, and now inflation, that to me would just be a buying opportunity. Also, given everything we've said about the labor market, all right, that is to me, the two main reasons why this would be a buying opportunity for TLT. But again, does it have to happen? Does it absolutely positively have to happen? No. But again, just be prepared. It doesn't cost anything to keep something on the side, and you don't want to be staring at the screen, praying, please go up, because I have nothing left to add in case we see prices decline. All right, so I'm leaving this majestic circle right here as a reminder of what could happen, not what necessarily has to happen. All right. And again, why do I stress that it doesn't have to happen? Well, if you also look at this descending wedge that we have right here, the last bounce was precisely at, the lower bound of the wedge. I've been hinting at the fact that perhaps we see, a fake out at the low and then we break out. But it doesn't have to happen. It could just be a vanilla descending wedge where you go, you bounce again, you bounce at the low, and then you break out. All right? Be open-minded is what I'm trying to say. And, the last couple of weeks have been interesting. We've backtested, as we always do, all right, the trend, the downward facing trend line, as we did in 2024, we break out, we backtest it once, we backtest it twice, and we're off to the races. Even right here, we had another trend line. I eliminated it just to keep this chart clean. We break out, we backtest it once, twice, we go off. All right, then another trend line, we backtest it, and we're off, potentially. All right. And so for the time being, we're moving away from, the majestic circle. That's what I'm going to call it from now on, which is nice to see. Today's a mixed day on bonds, given mainly, the events that we're seeing in oil. Early in the day, we had kind of a risk-off trade, with yields quite lower. The low point was 4.8, where 4 basis points up. And again, basically, we're just kind of bobbing around between, this is going to be bad for the economy, this is going to cause inflation. They have that kind of dynamic occurring in TLT for the moment. But overall, this was a good week for TLT. This is the kind of data you want to see. All right? You want to see downward surprises on inflation. We got that. and you want to see further degradation of the labor market. We got that with continuing claims and initial claims. All right. So overall positive week. And what's more positive is that, again, TLT reacted in a positive manner. We've been talking about this, in my previous videos, how, throughout, from April till really now, this is the first read where inflation has actually been positive, and we've had extremely benign reads on inflation, and that really, the bond market didn't really seem to care, because again, to me, the bond market was quite hell-bent on pricing in, this stagflationary outcome. And again, I think it's also a good, idea to go back and see what, the 06 and 08 price action was in relation today. I use, I think it was Connor in my last video. This one's for you. You actually asked me for, to go over the 06, 08 analogy in relation to today. And so here we go. The idea here is basically, why do I talk about, 06 and 08 in comparison today? Well, for two reasons mainly. First of all is basically what the chart looks like, all right? What you basically have is a first move up, followed by retrace, which then gets followed by a kind of a noisy move up. It's not straightforward. We have, some blips here and there, some small, declines, but overall, move up. Then you have a sideways chop for a while. That culminates into the first major peak, this kind of W formation. And if you go and look at 2006 and 2008, what you have is this, again, first move up, retrace, a noisy move up, sideways action for, quite a bit. And then you have the first major peak and that W formation. And again, ever since I started talking about this analogy, I was talking about a possible deviation. I was not expecting this to play out precisely as 2006, 2008, mainly because no two cycles are the same. You're going to have things that differ. So again, potentially the deviation actually was these last few months right here, starting in April. We were following it quite well, honestly, up until this point right here, and this is probably the deviation. Although, if you actually go and look, we haven't swept this previous high in the 30-year chart this time around, but we got fairly close to it. All right, so do keep that in mind as well. The second reason why I look at 2006, 2008 is because of inflation. Today we have what I call inflation PTSD. We're afraid of 2022 happening again. And so we've kind of let inflation be kind of our the lens through which we watch everything, we look at everything. In 2006 and 2008, they actually had inflation. All right? Inflation bottomed out in 2006 at 1.3. And 2 months before Lehman Brothers collapsed in July of 2008, we were at 5.6. All right. Let me see if I still have that article open. The CNN article from 2008. I do. Here it is. You had many people. This article is from June of 2008, arguing for rate hikes. Why? Inflation was high. And keep in mind, this was when the Federal Reserve had cut interest rates by quite a bit. By the time it was July of 2008, we were sitting at 2% on the Fed funds rate. We had about 325 basis points of rate cuts at this point. And like today, we had a lot of people talking about, rate cuts have spurred inflation. We have to go back up because, inflation's very, very high. It's uncomfortably high. Why did we cut rates and all that good stuff? All right. So there's a similarity, if you will, between you know, 2006 and 2008 and today's, inflation narratives. All right. So those are the really two main reasons why I look at 2006 and 2008. As far as, this cycle is concerned, you really want to see some follow through right now. And again, I think that the summertime is really the time where, you'll want to see TLT actually move. And, we're looking at the 30-year bond here, move in a convincing manner. Given everything we know about initial jobless claims that usually like to peak in the summer, the beige book has been pointing towards, further weakness. We've looked at, the revisions in payrolls. Already payrolls were nothing too exciting, and the revisions have been brutal, to say the least. We've had a combined nearly 200K here, just shy of 200K of revisions from really, the beginning of the year, and with more potentially to come, in April's read and May's read. Again, May's read was fairly okay with 139, compared to expectations at least. But again, we know that, revisions have been to the downside. All right. We only had, in 2024, we only had one in March, July, and a couple of more through the fall of positive revisions, meaning revisions to the upside. So the base case is that you continue to see downward revisions to payrolls. And again, that continues to build, as I was saying before, on the bullish case for TLT. All right. Not necessarily bearish on stocks, because again, as I always say, just because the economy is slowing is not a good enough of a reason, to go out on short, the Mag 7 or the S&P 500. All right. Stocks only price in a recession when it's actively smacking it in the face. And arguably, you could also say that to a certain extent about the bond market. All right. Particularly, this part of the cycle where the bond market has said everything and the opposite of everything, recession in 23.3, now then having to backpedal that. As I said before, again, you know the drill. So to me, rates at these elevated levels, and again, not financial advice, but to me, a 30-year at 4.8, you're getting paid to wait, and you get downside protection in case of, the economy getting slowing even further. All right, you're no longer at the zero bound where really the only direction was up. All right, a 1.1 30-year bond really doesn't offer that much protection at all. All right, we're at the opposite spectrum of that. That potentially there is a little bit too much pessimism about inflation, as I've been saying, from the start of the year, and a little bit too optimism on growth, given everything we know about claims, continuing claims, the quits rate, the payroll reports, the beige book. I haven't made a video on the latest beige book, but again, you continue to see how, there's abundance of labor, and, businesses don't really have that hard of a time to find jobs. Continuing claims continue to move up, meaning that, again, it's harder to find a job for, people that actually lose their job. Okay. And again, all of that put together to me says that potentially, duration and 30-year bond is a good buy compared to history, where we are in the business cycle. But again, I want to stress that the summertime is really when I want to see TLT make some progress. And what am I talking about progress? I want to see, at the very least, a breakout of this falling wedge right here. All right. To the upside, of course. And ideally, you'd like to be above the $94 local top of April 2025. That is ideally where you would like to be, and we'll reassess as things evolve throughout the summer. But again, the summer will be in my opinion, the kind of the time to look at bonds. All right, particularly given everything we've said about the labor market, the state of the economy and everything. All right, so I'll leave it at that. Again, just to summarize, inflation benign, PPI benign, initial claims not so benign, still at fairly elevated levels that at the very least suggest that we are likely to see the unemployment rate go up in a month's time when we get that non-farm payroll report. Continuing claims up. We've broken out of this range right here. Wouldn't be surprised if we retrace just a little bit next week. But again, this is exactly what we saw last year during this exact time of the year. Right, it was around the end of May and June where we kind of got to new highs. All right, so continuing claims continue to go high. Quits rate still at cycle lows. We kind of went back to 2.1 for a bit, but we're back where we were, range lows. You know what that means? People no longer see a strong labor market, so they're staying put. They're no longer voluntarily taking risks. Wages are likely to stay at the very least. At the very least, they're not going to explode higher in such an environment, which is not supportive of inflation. All right. Wages where they are, where they will go, what the outlook is, given everything we've said. Don't expect inflation, honestly, to be that much of a problem. I mean, rather, let me rephrase that. I'm not expecting inflation to come from the labor market. If we do get some kind of bout in inflation, that will just likely be a form of disinflationary inflation. If again, as convoluted as that sounds, and again, why? Because as far as individuals are concerned, if you have steady wages and prices increasing, you're spending more amount of money on the same amount of goods, leaving you with less money to spend on anything else, meaning cinemas, booze, alcohol. Have your fun. All right, go out and have fun. And if you're a business and you know that your customers are mostly tapped out and unlikely to stomach most of the price increases, meaning that you no longer have the pricing power that you had in 2022 when you could pass on most of the price increases to your customers, because again, they had a tight labor market. Labor demand was outstripping and outpacing labor supply. Wages could go up. People could stomach the price increases. If you know that and you're a business that you no longer is in such an environment, so that you don't have pricing power, and again, you have flat revenues and prices going up, the only way you have of protecting your margins are through layoffs. So any bout of inflation from here on out, in my opinion, will just likely lead to pressure on margins for businesses, which in turn will eventually lead to layoffs. All right, and again, don't look at the S&P 500 layoffs. More like your small and medium business sized businesses, rather, where margins aren't as elevated as these mega corporations. Which, by the way, although and I'll promise I'll wrap it up now, you've actually started to see some anecdotal evidence. Microsoft has pointed towards layoffs. Google has been buying out some of their search department. Procter and Gamble, 7,000 layoffs announced, job cuts announced. So again, don't look so much at the mega corporations. Look at the small and medium businesses. But even if you're talking about the huge corporations, you're already starting to see that shift occur right there. As far as today is concerned, we're bobbing around between flight to safety, given all the Israeli strikes on Iran for nuclear uranium enrichment facilities, and the consequences of that, meaning higher inflation potentially coming from a higher oil. Again, given most of the oil, well, 40% comes from the Middle East. So again, that of course will put higher pressure to the upside on oil price. So again, I'll see if I can make a week ahead video for TLT tonight, and I'll leave it at that. Hopefully this video was insightful for you, and I'll see you next time. Bye.